In this video, I discuss what could happen next for the stock market. Price is currently grinding up higher in a wedging pattern. We also look at the effects of the pandemic on the US consumer credit, current trends in continuing jobless claims, and how this could all affect future GDP growth. Hello everyone, it's Sajad. I hope you're having a great week. Before we get to the chart, let's go through some of the news first, some of the economic data, and let's start with daily cases in the US. Now, despite the many types of vaccines available, we're still very elevated in terms of daily cases. You can see I've marked off the 150,000 area. Cases at the moment actually are above 200,000. Now, as we've seen here in Europe, what that means is more restrictions, more lockdowns, and generally a negative effect on the economy, especially as most Western countries now rely on consumer spending as the majority of their GDP share. You can also see here in Europe, we're still struggling at the moment, despite the lockdowns and the restrictions. We might assume that it'll take 3 months for things to get back to anywhere near normal, as people are now taking the vaccine. But to be honest, this is anyone's guess. We're still waiting for the relief plan or aid package from the US, and let me show you why that's so important. Let's have a look at some economic data. This is US consumer credit, and the actual figure we saw recently reported was 7.23 billion US dollars. So what does this actually mean? Because this was way off what was forecast. You can see there on the bottom part of the chart, a $5.5 billion US dollar decline leaves total revolving debt at lowest levels since 2017. Now you can see this is a massive problem for an economy that's based mostly on consumer spending. So revolving credit has declined now for the 7th time in the past 8 months. And in our debt-fueled economies right now, if people can't borrow money, or they're choosing not to borrow money, what's the alternative? The only alternative is more fiscal stimulus. Governments literally giving people money to use to go out and spend. The big question, of course, is when will that all end? When will the bubble burst? They've actually managed to maintain this for longer than anyone ever expected. But is there any actual limit to what the central banks can do, or will their hand be forced by, for example, future significant inflation? Please let me know what you think about that in the comment section below. This chart is US continuing jobless claims. We're still above the 5 million level. But what's interesting here is, yes, we have the downward trajectory, which is obviously to be expected after that peak we had around late May. But look where normal levels reside, a lot lower. And we're still not getting to those levels. And we were just talking about GDP. Well, UK GDP has actually slowed down to a 6-month low. And this is the weakest growth. I mean, some of this was expected due to more restrictions. However, the opinion of a lot of economists is there will be a massive rebound in consumer spending. They said there will be a rebound towards the end of this year. But obviously with the continuing pandemic, that's not happened. But they're assuming now there will be a massive rebound in 2021. But what's the big issue in Europe, especially with the UK and Germany right now? Well, Brexit. And I discussed that in my last video. I don't know if any of you have experienced it, whether you're in Europe, US, or other countries worldwide. There seems to be a lot less stock of products, any type of retail products. Now, in my opinion, this is a problem for many reasons. The main one, however, is that if there is enough consumer demand for a particular product, but there just isn't enough inventory, then of course the overall revenue for that company is going to fall significantly. Now, if you take a combination of many different companies with falling revenue, this will hit GDP hard. And I feel they're definitely underestimating the slowdown in growth over the next couple of years. So let's get onto the stock market, and I'm going to concentrate here on the S&P 500. I'm just going to zoom in on price action we've seen in the past 2 to 3 weeks. What's interesting here, I've been watching this very closely, and it seems to be a wedge pattern forming. Now, if you've been watching my recent videos, I'm expecting that a rally continues right up until Christmas, and that has been happening, but this is not significant rally, it's more of a grinding up in price. So just to compare, if you look back since the March lows, we've had clear areas where the market has rallied strong. However, since the 9th of November, over the last 1 month, this is looking almost like a corrective rally upwards. So why is this important? Well, in classical analysis, when you get a wedge pattern like this, it could set up for a massive fall. So I wanted to discuss a couple of alternative scenarios we have here in terms of price structure. So this is a classic pattern we see in trading, and I've just showing you some examples here. So in an uptrend, what happens is you get higher highs and you get higher lows. And then if you draw the trend lines, they form this wedge. And if you have a look at price action recently, and let me just zoom in again, you'll be able to see this very, very clearly. You can see price respecting this trend line at the moment, the upward trend line and the downward trend line as well. So what can happen after that is you get a break of that lower trend line, and that can be significant. You can get a huge move in price, and this can sometimes be a very good trading opportunity. But again, this may just be a short-term sell-off. Now, in terms of structure, for those of you who are interested, there's a couple of ways to actually look at this. And one way to look at this is we're going into a diagonal impulse wave here, and these usually happen at the beginning of the move or at the end of a move. So there's a possibility we could be completing a correction, a 3-wave correction up. Now what does that actually mean? Well, one way to look at it is this entire move from the beginning of September until now is not over in terms of a larger market correction. So we've talked about a lot of the potential effects we have on GDP. We know that the retail sales and other consumer spending numbers are not going to be as good as expected going into Christmas. And it seems like government central banks are struggling now to actually get through new bills, new relief aid packages, etc. So if that's the case, then we could be setting up for a move back down to the lows we saw here around the 3200 level. So let me just draw that. So in that scenario, this entire move would be one large structure. So one large correction sideways, and then we resume a rally upwards. Now, in terms of time frames, if this is a possibility, then I would expect this to take a couple of weeks. But what we tend to see in the stock market is the sell-offs tend to be quite sharp, quite rapid. So this could happen very, very quickly. And then by January, February, we could be around the 3200 level, and that could be potentially another buying opportunity once the vaccines have actually taken effect, and potentially we could put the pandemic behind us. I mean, obviously the economic concerns are going to be significant. So that's one scenario. The other scenario just to be aware of here on the S&P. So we talked about this being a final 5th wave impulse. Well, it could be a final 5th wave impulse, but it could be completing in an overlapping manner. And that's why we could be getting this wedge pattern here. Now, it's very, very difficult when you get this type of scenario to actually predict what could be an ending target. But one thing we can do if we use the fib extension is we can scroll over to the March lows, to that high we actually saw on the 3rd of September. Now, if that's a wave 3 high, then one of the levels we'd be looking at is around the 3770 mark. So that would be an area we'd be looking at if we continue to just grind higher in price slowly as we're doing at the moment. There are some higher targets as well, 4100, 3900, but then that really wouldn't fit this kind of wedge pattern. Now, if this is a scenario that is playing out, then the correction would be quite significant because this would be the end of an impulse here. So we'd be correcting the entire move from the lows in March. So we would expect a significant move down. Again, the first target there would be the 3200 level. That's where we got support, and that's where likely we saw a 4th wave low. So how will you know if there's going to be a massive sell-off around the corner or we're setting up for one? Well, I would say watch out for the VIX. Sometimes this can give us the earliest signal, as we've seen in previous sell-offs this year, sharp sell-offs, and we've always had significant movement in the VIX when we've seen those. So any kind of breakout here or gap up could be an early sign. And just finally, I just want to show you briefly on the Nasdaq here as well. So this is the same area we're looking at, but you can see very, very overlapping price action, which is a concern. So either the whole correction from September is not over yet and it needs to complete, or we're getting this final impulse wave up, and potentially it could end in the next couple of weeks, so just before Christmas. So watch out for that. Let me know in the comment section below what you think. Also, please let me know if there's any other markets you'd like me to cover. I'm more than happy to do a separate video on that. Thanks very much for listening.